Hi there, welcome to AI Investor Talk. Foreign exchange, or FX, volatility refers to the fluctuations in the value of one currency relative to another in the global financial markets. This volatility is a key factor in international finance and trade, impacting everything from multinational corporations to individual investors. A deep dive into FX volatility involves understanding its causes, effects, and how it is managed. Causes of foreign exchange volatility. 1. Economic data releases. Inflation rates. Higher inflation in a country typically leads to a depreciation of its currency, as purchasing power decreases. Sudden changes in inflation can cause significant volatility in FX markets. Interest rates. Central banks, such as the Federal Reserve, influence FX rates through their monetary policy. When a central bank raises interest rates, it can attract foreign investment, leading to an appreciation of the currency. Conversely, lower interest rates can lead to depreciation. Economic growth. Data, GDP growth, employment numbers, and other economic indicators can affect investor confidence in a country's currency. Positive data can strengthen a currency, while negative data can weaken it. Political events and geopolitical risks play a crucial role in foreign exchange volatility. Elections and political instability can lead to fluctuations in a country's currency, as investors may perceive higher risks. Trade wars and tariffs, like those between the United States and China, can cause significant FX volatility. Tariffs and trade barriers can affect currency values by altering trade balances and investor sentiment. Geopolitical crises such as wars, terrorist attacks, or diplomatic disputes can cause sudden shifts in FX markets as investors seek safe haven currencies, like the US dollar, Swiss franc, or Japanese yen. Market sentiment and speculation are also key drivers of FX volatility. Investors' willingness to take on risk can lead to shifts in currency values. For example, in times of global uncertainty, investors may move from riskier emerging market currencies to safer ones, increasing volatility. Speculative trading is another factor. Traders in the FX market often speculate on future movements of currencies. Large volumes of speculative trades can cause significant price swings, especially in less liquid currencies. Central bank interventions can significantly impact FX volatility. Sometimes, central banks intervene in the FX market to stabilize their currency. They might buy or sell their currency to prevent excessive volatility, which can itself lead to temporary spikes in volatility as the market reacts. Monetary policy statements and actions by central banks regarding future monetary policy can lead to significant FX movements. For example, a central bank hinting at future rate cuts or hikes can cause market participants to adjust their positions, leading to volatility. Global economic events. Financial crises, like the 2008 financial crisis, can lead to extreme FX volatility. Investors reprice risk across the world and move funds into perceived safe haven currencies. Natural disasters such as earthquakes, tsunamis, or pandemics can disrupt economies and lead to currency fluctuations, especially for countries heavily affected by such events. Effects of foreign exchange volatility. Impact on international trade. Volatility in exchange rates can affect the profitability of exporters and importers. For example, if a company sells goods overseas, a sudden appreciation of its home currency can make its products more expensive in foreign markets, reducing competitiveness. Companies often use hedging strategies to protect against FX volatility, but this comes at a cost. Increased volatility can lead to higher hedging expenses, which can impact profitability. Investment flows. Foreign direct investment, or FDI, can be deterred by FX volatility. Companies may be reluctant to invest in countries where currency values are unpredictable, which could lead to potential losses. Similarly, portfolio investment can be affected. Investors might shift their portfolios away from countries with high FX volatility, seeking stability in less volatile currencies or assets. Impact on inflation. Imported inflation occurs when a depreciating currency makes imports more expensive, leading to higher inflation in the importing country. This is particularly significant for countries reliant on imports for essential goods like oil and food. In response, central banks may need to adjust their monetary policies to manage FX-induced inflation, which can further influence currency volatility. Corporate earnings and financial stability. Multinational corporations, or MNCs, with global operations are particularly vulnerable to FX volatility. Fluctuations in currency values can impact their earnings when converting foreign revenue back into their home currency. Additionally, debt servicing becomes a challenge. Companies and countries with significant debt denominated in foreign currencies may struggle with repayments if their home currency depreciates significantly, leading to financial instability. Managing foreign exchange volatility. Hedging strategies, forward contracts. Companies can lock in exchange rates for future transactions, reducing the risk of adverse currency movements. Options, contracts. Currency options provide the right, but not the obligation, to exchange money at a pre-agreed rate, offering more flexibility than forward contracts. Natural hedging. Some companies mitigate FX risk by matching currency inflows and outflows, such as sourcing materials from the same country where they sell their products. Diversification, currency diversification. Investors and companies can diversify their currency exposure to reduce the impact of volatility in any single currency. Geographical diversification. Operating in multiple countries with different currencies can spread the risk, though it also requires careful management of FX risk across various regions. Central bank policies, interest rate adjustments. Central banks may raise or lower interest rates to influence currency values, aiming to stabilize their currency and reduce volatility. Market communication. Clear communication from central banks about their policy intentions can help manage market expectations and reduce speculative-driven volatility. Risk management practices, scenario analysis. Companies and investors often use scenario analysis to assess potential FX volatility impacts under different market conditions, enabling them to prepare and respond effectively. Stress testing. Stress testing can help firms understand how extreme FX volatility would impact their financial health, guiding their risk management strategies. Conclusion. Foreign exchange volatility is a complex and multifaceted phenomenon driven by economic, political, and market factors. Its impact on global trade, investment flows, corporate earnings, and financial stability makes it a crucial element of financial risk management. Understanding the causes of FX volatility and implementing effective strategies to manage it is essential for businesses, investors, and policymakers navigating the interconnected global economy. While FX volatility presents challenges, it also offers opportunities for those who can anticipate and respond to currency fluctuations effectively. Thank you for watching. Please like and subscribe.